based on the names that I see here and people that's joined in, it's people that has mostly has been in 1502 last semester. So it seems as if you had a very good first semester then now from an accounting point of view. And we hope that this semester for the FAC 1601 and the FAC 1602 is also going to be successful. Just the big difference between 1601 and 1602 is, of course, that 1601, you are actually doing 3 more sections. There's 3 more chapters that were what you are doing if you are doing 1602. So the 1601 is actually for the students that is still continuing with accounting, 2nd and 3rd year, and hopefully honors. And then if you are doing 1602, this will be your last accounting module, which means that you may specialize in other directions such as perhaps economics or HR or IOP or whatever the case may be. Just a reminder, guys, on what we are doing also here in terms of our online tutorial classes. Just please remember that at the end, you must complete the feedback form and you must also complete the register. The links has been posted by Bronwyn under the chats. So please work from that. And then as far as the notes is concerned, the notes that I'm going to work on today is also under Teams. If you just click onto your files there, your study notes, and your presentation is all under that icon. You can get it there. It is actually advisable just in future just to print that out so that you've got it. So if we do have our sessions, it would be far more productive if you have got the sessions and you can then work on that. Without further ado, guys, let us get going with the work. Got some noise here. Okay. Right, I think it's gone now. Just as an introduction, guys, you need to understand that when we have done FAC 1502, the focus was just on general bookkeeping. And we did the financial statements only of a sole trader. In FAC 1601 and 1602, we actually extend our knowledge and our accounting knowledge on financial statements, and we also do the financial statements of a partnership as well as a closed corporation. Financial statements in FAC 1502 was limited to the statement of profit and loss and other comprehensive income, statement of changes in equity, and statement of financial position. But now for FAC 1601 and 1602, we also add in the next financial statement, which is the cash flow statement. So in this course, we are focusing on 4 different financial statements. So your financial statements will include then the statement of profit and loss and other comprehensive income, statement of changes in equity, statement of financial position, as well as your cash flow statement. And the course is, as you guys may see, this course is called Financial Reporting. So 75% of your exam is just focusing on financial statements. Absolutely important. So under study unit number 1, where we discuss the introduction to the preparation of financial statements, this has just got to do a few things that I need to remind you of, which you of course know from 1502. And the first one is that financial statements are prepared for a financial year, a financial period, normally 12 months. So in that 12-month period, we want to know what is the profit or the loss that the business has made. And that is, of course, portrayed in your statement of profit and loss and other comprehensive income. And we also want to know at the end of the financial year, what is our assets worth, what is all our equity, what is all our liabilities, and that is portrayed in your statement of financial position. In study unit number 2, we deal with financial statements of a sole proprietor, which is just revision of the FAC1602 work. It just reminds you about the fact that you get a trial balance that is used to actually do your financial statements. But together with your trial balance, you will also have adjustments or additional information that will impact on the amounts in your trial balance. Adjustments such as depreciation, accrued expenses, prepaid expenses, income received in advance, accrued income, additional credit losses, allowance for credit losses. All of those adjustments that we dealt with FAC1502, you will still work with those adjustments. Okay. Study units number 1 and study unit number 2 is not actually for exam purposes. It is just more a revision for you of the work that you have done in FAC1502. Your actual work for FAC1601 and 1602 starts with study unit number 3, where we are discussing the establishment of a partnership as well as the financial statements of a partnership. So when we speak about the partnership, remember a partnership is a type of business. 2 or more individuals will come together. There is a legal relationship between the 2 or the more people that come together, and that business is then called a partnership. One of the big advantages then of forming a partnership as opposed to the sole trader is that you will have a bigger capital base, more money, instead of just like one owner. Now we will have more people, more money in the business, which will mean that we can negotiate, therefore, bigger contracts and make more profits there because we've got a bigger amount of capital available. Partnerships. Remember now, a partnership agreement between the 2 partners, 2 or more partners, can be verbal, since that verbal agreement is also valid in a court of law. However, it is strongly recommended that the partnership agreement must be put down in writing, just to avoid whatever is perhaps if the partnership is not going well in a few years' time, or there is some disagreements, then it is always, that is why it's always advisable to have this partnership agreement in writing. Information that you will get in your partnership agreement will be the name and the scope of the business, the capital contribution of each partner, how much does each partner bring to the party, what is the ratio of the profit distribution, how the profit will be divided amongst the partners, what is the interest on capital that the business will now pay the partners. If one of the partners has made a loan to the business, what is the interest rate on that? What's the interest rate on the current account? What is the interest rate on the drawings? Or how much is the salaries that they must get? Are there some of the partners that is entitled to a bonus? All of those items will be contained. That is the conditions of the partnership agreement. It is important to note that a partnership agreement is an accounting entity and not a legal entity, and that the partnership does not pay tax. The business in itself does not pay tax. However, the partners in the individual capacity, they are paying taxes on the income that they are getting. Because we may have the situation that one partner is perhaps involved in 3 different other partnerships. We do get that with doctors, because you guys will know, sometimes you want to go to a doctor and you want to see a particular doctor, and they tell you that that doctor is only at that practice on a Monday or and perhaps on a Wednesday. Other days he is at other practices. So if we now want to calculate what is the tax that that doctor must pay now, that partner, we must take a look at the income that he will get from all these other activities, and that will be his taxable income. So based on that, he will be taxed. But the business in itself, the partnership, they are not paying tax at all. As far as the accounts is concerned in a partnership, because we are dealing with more than one owner, each one is called a partner, each partner will have its own capital account. So there will be a capital account for partner A, a capital account for partner B, a capital account for partner C. Each partner will have its own capital account. Each partner will also have its own drawings account. Okay, so there will be a ledger account called drawings partner A, drawings partner B, drawings partner C. Each partner will have its own drawing account. And then, of course, each partner will also have his or her own current account. Now, the current account is like the private account. In this account, we will transfer everything that the partner is entitled to. Everything that is contained in the partnership agreement, we transfer that to his current account. Now remember, in the sole trader, the profits and all of that went to the capital account. But in a partnership, the capital accounts is only for increases and decreases to the capital. Everything else that the partner is entitled to, whether it is salaries or a bonus or profits, that we transfer to his own private account, being his current account. Right, so each partner will have his own capital account, his own drawings account, and his own current account. The conditions of the partnership agreement, which will be contained in the question that they will give you, all of that must be disclosed in the statement of changes in equity. So in your statement of changes in equity, there will be information on salaries and the bonuses and the commissions, interest on current account, interest on the capital account, interest on drawings, all of that information, how the profits must be shared, we disclose that in the statement of changes in equity. Very important, the next point. If there's no written agreement as to how the profits must be shared, then the profits and losses of the partnership is shared amongst the partners in the ratio of their capital contributions. So if you come across the question where they don't tell you how the profit must be shared, you must then take a look at each partner's capital contribution, and in that ratio, the profits will be shared. If one partner's capital is 100,000 and the other one is also 100,000, each one has contributed an equal share. Therefore, they will be sharing their profits equally. If one partner has contributed 60,000.
I'm sorry, sir.
Capital, yes.
Sorry, they said. Now, I'm just wondering, you said now with the three partnerships, there's three accounts for, so my question basically is just, I don't really understand, like you said, each one will have its own ledger account, right? Let me just quickly open it up again there. Here we are. Sorry. My question basically is just, so each one has its own capital account, own drawing account, own current account. So what I understood lastly, I did my first accounting module a while ago. What I understood from the sole proprietor, right, is that each one has its own, of course, the owner of the capital is everything. It's the equity in itself. So my question is, you said all like the dividends, all losses, all profits, everything that's owed to him, then will be in the. But then why doesn't each partner then has its own, just like one account for each one? Because obviously they add the capital together. Then why don't they get in their drawings account, for example? I don't know if it makes sense.
Absolutely fine. Let me just quickly explain to you. Okay. Each partner must have its own capital account because it is possible that partners contribute different amounts. So we cannot group all the contributions together in one account, because it may be that the profits are shared in the ratio of the capital contributions. Now, if you've only got one capital account where you put everything together, say now, A has contributed 100,000 and B has contributed 50,000. Then your capital account will only show 150,000 Rand if you've got one capital account. But if you want to see, is Bianca okay?
Yeah. I understand why there are 3 accounts for each one. I understand that. I just don't understand why each has to have 3 accounts. For example, so let's say person A gives 100,000 Rand for capital. Then also, if he makes, why can't it be put in the same, sent to the same account? That's kind of my question. Because so that person A has his own account of the losses, of the profit, of everything that he owns for himself, and then also person B, also person C. Why is there 3 accounts? I don't understand that.
Okay, right. Now, the way that on the same basis, if you understand that each one must have its own capital account, on the same basis, does the drawings account also apply? Because you can't just have one drawings account, because you need to know who took the money out. That is why each partner must have its own drawing account. So at the end of the year, we can see how much each partner has taken out. And on the same basis, each partner must also have his own current account, because partners don't get the same salaries, or they don't get the same share of the profits. And that is why we need to have a current account for each partner as well. Bianca,
thank you.
I hope that clears that up. As we go along with the stuff, it will become more clearer to you. Okay? Or so we hope it should be like that. Okay.
Thank you. I hope so too.
Right. Okay, we continue. I was explaining to you guys what will happen if there is no written agreement. So if your question paper doesn't tell you how the profits must be shared, the rule is the profits and losses are shared amongst the partners in the ratio of their capital contributions. So if partner A has contributed 60,000 and partner B has contributed 30,000, 60,000 to 30,000 is a ratio of 2:1, which means that partner A will now get 2/3 of the profit and partner B is going to get 1/3 of the profit. All right, that is in a ratio of 2:1. So no written agreement. The question don't tell you how the profits must be shared. Then you go to the capital contributions and you share it then in that ratio. The next important note is that if a salary is paid during the course of the year to a partner, we don't call it salary. We don't record it as a salary. If a salary was paid during the course of the year, we record that as drawings. Always remember that. It's always there in your question paper. Salaries paid during the course of the year is not recorded as salaries. We call that drawings. The only time you work with salaries is at the end of the financial year. And then you take the total amount that the partner is entitled to. You transfer that to his current account. And how do we know how much is he entitled to? You will have to go to the partnership agreement to see how much is the partner entitled to. So whatever he is entitled to as per partnership agreement, you transfer that to his current account. Okay. But if we pay him out during the course of the year, it is regarded and recorded as drawings. Very important, that one, guys, because you will always get that in your exam. So now let us take a look at the equity of a partnership. In a sole trader, when we spoke about the equity was just capital. But now when we speak about the equity of a partnership, the equity of a partnership will consist of both partners' capital accounts, or if there's three, then it's the three capital accounts, the current account of both partners, and an account that we call the asset replacement reserve. Now let me explain to you what is an asset replacement reserve. An asset replacement reserve is created when the partnership will now decide that from each year's profit, they are going to put a portion away of that profit into almost like a savings account. The reason for that is if you are working in a business that has got quite expensive machinery in excess of 2 or 3 million rand, and that you can get in the product if you are in the field of, if you are employed perhaps or working with a business in the production field, you will know that those machines is quite expensive. Now those machines is not going to last forever. Also due to technology, you need to upgrade those machines from time to time and perhaps replace them. And for that purposes, it is possible that the partnership may decide to create an asset replacement reserve. It's money from the profits that they will keep one side in case they need to make use of that money again to buy these assets. So it is possible that from the profits every year, the owners may decide to keep a portion of that profits one side. We call that an asset replacement reserve. The money may accumulate there, and it is part actually of your equity because it is past profits that will now accumulate into your asset replacement reserve. Another example of your asset or the use of your asset replacement reserve is that you can have a partnership that is now renting a portion of a building from somebody else, but they are thinking of buying their own property in the future, and now they are saving up for that. So each year they will take a portion of the profits and put that aside into an asset replacement reserve so that they perhaps has got in the future, they will be able to buy their own property now. But that profits that they've put away actually belongs to the owners, belongs to the business. And that is why that is part of equity. It's part of the equity of the business. So if you want to see what is the equity of a partnership, the equity of a partnership will consist of the capital accounts, the current account as well as the asset replacement reserve. Any questions on this at this time on partnership, guys?
Hi, good day, sir. I just want
Yeah.
to ask you something. The asset replacement reserve account, would that be part of the partnership agreement?
It could be part of the partnership agreement. In most cases, it will be. So they will state there how much each year must be transferred to the asset replacement reserve.
Thank you.
Okay, looks like everybody's okay with that. Let us turn our attentions now, guys, to the notes. Right on page 1 of your notes. Just a summary of what we have discussed so far already. The financial statements of a partnership. In this study unit, you must be able to do a statement of profit and loss and other comprehensive income, statement of changes in equity, statement of financial position. Remember the partnership agreement, preferably in writing, but the items that is in that partnership agreement will include items such as the name of the business, how much each one contribute, how profits will be shared, what is the salaries. All of that is contained in the partnership agreement, as well as how much money must perhaps be transferred to your asset replacement reserve. Important to note once again how we treat the salaries to partners. If salaries are paid during the year, it is called drawings. At the end of the year, you transfer the salaries that the partners are entitled to their current accounts. Okay. Next important point, guys, as far as the profit sharing ratio is concerned, remember, if the question don't give you a ratio, you use the ratio of the capital contribution of the partners to calculate what is the profit share that each partner will receive. Then just the current accounts of partners. A current account of a partner can have a debit or a credit balance. Now, a current account is equity. Remember, it's part of equity. Credits is seen as positive and debits is seen as negative. Everything that a partner is entitled to as per partnership agreement is transferred to his current account. And at the end of the year, the drawings is then closed off to the current account. Let me just explain to you as far as the debit and the credit balances are concerned here. A current account of a partner normally will have a credit balance, which is therefore a positive balance because it is equity, which increases on the credit side. But it is possible that a partner can have a debit balance in his current account, because it may be that we have transferred 50,000 Rand to the partner's current account. He must get drawings now. The 50,000 that we transferred to his current account was his profit share. Now we have transferred his salary that is entitled to of, say, 60,000 Rand. We transfer that also to his current account. So in his current account, there is 50,000 Rand of profit, 60,000 Rand from his salary. But if his drawings was 150,000 Rand, he's taken out much more than what he is entitled to. That current account will now have a debit balance of 40,000 Rand. That partner is actually owing the business money. The current account, therefore, will have a debit balance. So if a partner is taking out much more than what he is entitled to, then the current account will go into a minus, into a negative. And therefore, the current account, in the case that I explained to you now, will have a debit balance. All happy on that?
Sorry, can I just have some further clarification on how the movement of funds, where it reflects? So when a partner initially makes a contribution, that goes into the capital fund, and any further money that the partner puts into the business goes into the capital account. And then any money that the partner takes out during the year is placed into the drawings account, and then the current account only comes into play once the financials are being completed. Is that correct? So any movement during the year is not placed on the current account. The current account is only dealt with at the end when reports are.
Okay. That's right.
And I also just wanted clarification on the difference between the salary or any other money that the partner is entitled to versus the profit sharing. So are they one and the same thing, or is it two separate values or calculations or whatever that needs to be done?
Okay, right. I think you guys are a little bit too advanced. We are going to get there. Okay, so you are absolutely correct in saying that each partner has got its own capital account, and the capital account is only for the contribution of capital. Each partner has also got its own drawing account, and whatever that takes out of the business is recorded in the drawings account. At the end of the year, we only work now with the current account. The current account will indicate, or everything that he is entitled to goes into the current account. Salaries and profits are two separate items. So a partner can get a salary every month, and he can also get a share of the profit, which we transfer at the end of the year. So that will take care of that. And then at the end of the day, or at the end of the financial year, we take a look at whatever the partner was entitled to that was credited to his current account. The drawings at the end of the year, once we have concluded what is the drawings for the year, we close it off and we debit the current accounts then with the drawings. So on the credit side in the current account will be everything that he's entitled to, and on the debit side will be the drawings, and then you will calculate what is the new balance in the current account for the year. I hope that explained that one.
Yes, it did. Thank you.
Okay, right. Sini Pillay from another center. You can also complete the form, please. Just complete it as far as you can get, and then you can then just forward that to us. Right. We continue with our notes now. Right. We focus on our first financial statement, and the first financial statement is the statement of profit and loss and other comprehensive income. Nothing strange to you guys. Everything is the same as in the case of FAC1602. Start off with the revenue, which is your sales minus your sales returns, minus your settlement discount granted, get that answer, minus your cost of sales. Cost of sales is still your opening inventory plus your purchases plus import duties and carriage on purchases minus the closing inventory. Net purchases is purchases minus your purchases returns minus your settlement discount received, and that will give you the calculation there. The revenue minus your cost of sales is your gross profit. Okay. Actually, everything is the same in the case of the sole trader. So we will have our other income is our next heading. Rent income, profit on sale of asset, credit losses recovered, dividend income, interest income, whatever income you will have there, you will list it under the heading called other income. Your next heading is your distribution, administrative and other expenses. Put down all your expenses there, whether it's bank charges, donations, and water and electricity and rates and taxes, doesn't matter. Put down all your administrative, distribution, and other expenses, block them, and you add it up there. Finance costs. Finance cost will consist of your interest on loan and your interest on overdraft. Block that and add it up. Then we will calculate the profit for the period. Remember, the profit for the period is now the gross profit plus other income minus distribution, administrative, and other expenses minus your finance cost, and that will give you the profit for the period. Other comprehensive income, you must just have just label it as other comprehensive income. In this course, we do not, you guys don't have that, but it is just that for the format that you must show this, and then you will have your total comprehensive income, which is the same as the profit for the period. That is your statement of profit and loss and other comprehensive income. Exactly the same as what you have done under FAC1602. We move over to the statement of changes in equity. Quite a popular UNISA question, guys. So it is important that you understand what is happening here. So your equity consists of capital, both partners, current account, both partners, and asset replacement reserve. This part over here, that is your equity. Then you've got a column for appropriation. Appropriation means how are we going to appropriate? How are we going to share the profit amongst the partners? That we will show here in your appropriation column. In your appropriation column or your appropriation account, you also show the conditions of the partnership agreement you bring into account in this column. And then you've got the total column, which in most cases, for exam purposes, you will just ignore that column. And even if you go to some of the exam questions, it will tell you that you must ignore the total column. So as far as the columns is concerned, capital, both partners, current account, both partners, asset replacement reserve. If there is an asset replacement reserve, not all the partnerships will have an asset replacement reserve. It's only if they have an asset replacement reserve that you will show it, and then a column for appropriation. This statement starts here with the balances at the beginning of the year. The opening balances of capital, current accounts, and asset replacement reserve. Let us just speak about the balances now. Remember now, a current account can have a debit balance or a credit balance. So if the partner has got a credit balance, it is a positive balance. Credit balance is positive. But if the partner has got a debit balance over there, a debit balance is seen as a negative balance, and that is why your opening balance must therefore be indicated in brackets, being a negative balance. Let me just summarize again. The current account of a partner can be debit or credit. A debit balance is a negative balance, must be indicated in brackets. A credit balance is a positive balance. Okay, seeing as a plus. The asset replacement reserve, just have that balance over there. That is as far as the opening balances is concerned, coming from the previous financial year. Then we will speak about the fact that the first two lines of your statement deals with any increases or decreases to capital during the course of the year. So if the partners has increased the capital, you label it as additional capital contribution or additional capital contributed, and that is a plus to your capital. Your capital has increased. If one of the partners has withdrawn his capital during the course of the year, indicated in brackets, and it is regarded as a negative amount. So the first two lines deals with changes to the capital. On the next line, you take the profit for the year. This is the total profit that was calculated in the statement of profit and loss and other comprehensive income, and we transfer that profit now to your appropriation column. In that appropriation column, now going to apply the conditions of the partnership agreement. So let us now just make an assumption over here, guys. I am now just going to indicate to you what happens now. So we say, if the profit was 100,000 Rand, you will put down the profit as 100,000 Rand. Profit for the year transferred from the statement of profit and loss and other comprehensive income to your appropriation account, 100,000. Now you go back to the conditions of the partnership agreement, and in the conditions of the partnership agreement, you apply the conditions of the partnership agreement now. If it states that 10,000 Rand must be transferred to your asset replacement reserve, you transfer 10,000 to your asset replacement reserve, increasing your asset replacement reserve. But the available profit decreases now by 10,000 Rand. Even though we made a profit of 100,000, 10,000 Rand will decrease your profit now, and the available profit to be shared amongst the partners at this stage is there's only 90,000 Rand left now. We need to get that now. It's 100 minus the 10. If the partnership agreement stipulates that the partners must get salaries, say 30,000 Rand for the year, I transfer my 30,000 to the one partner. I transfer my 30,000 Rand to the other partner. The available profit will now decrease by 60,000 Rand. At this point in time, even though we made 100,000 Rand profit, 10,000 Rand we've put aside in an asset replacement reserve, 60,000 Rands worth of salaries was paid. So now there is only 30,000 Rand left to be divided amongst the partners. If the partnership agreement further stipulates that partners must get interest on capital, so now this one must get 500 Rand, and this one must also get 500 Rand for interest on capital, then the available profit will further decrease by 1,000 Rand. If we must pay them interest on current accounts, the partnership must pay them interest on current account. You transfer to their current accounts. Say this one 260, and this one must get 240. transferred to their current accounts, but the available profits will decrease by 500 Rand. There will be 500 Rand less profits available. Now, what happens if you get interest on drawings? In the case of interest on drawings, we are actually charging them, the business is charging the partnership or the partners because they have taken out drawings during the course of the year. And we will normally charge them interest on drawings. But this is only if it is in the partnership agreement. So interest on drawings is something that we charge them and their current account will actually decrease. So if partner A, okay guys, I must explain something else to you now, but I'm just going to finish this now. And then I'm going to go back to the interest on the current accounts because there's something there that is not right. Interest on drawings. Because the partners must pay in interest, their current accounts will actually decrease. And that is why we debit their current accounts. Decrease their current accounts. So if the first partner, Johns, must pay in 100 Rand, and the other one must pay in 150 Rand, you will see that it is actually a plus to our profits. The available profit will therefore increase by 250 Rand. We charge them, they must basically, it's almost like they must pay in the money, which will increase the available profit. I must go back to the interest on current account, guys, because I just want to show you something else here. If the partnership agreement stipulates that the partners must get interest on their current accounts. Now, this guy over here, who had, this partner, Johns, who had a credit balance, will be entitled to interest. Therefore, we will transfer to his current account the amount, and I'm just making an assumption here, it's 260 Rand. We transfer 260 Rand to his current account. However, the partner with the debit current account balance, this is the partner that actually owes the business money. He is not entitled to an interest. He must actually pay in interest. So that 240 Rand that you see there must actually be in brackets. Because that partner is not entitled to his interest. He must pay in interest. That is why the interest is a debit to his account. Just to clarify matters for you on this one. A credit balance means that he must get interest. A plus there is a plus here. A debit balance, the partner is not entitled to interest. Therefore, a debit balance means he must pay in and we will decrease his current account. A debit here in the balance is a debit in the current account. A credit in the opening balance is a credit as far as the interest is concerned. So let me just quickly rectify this now. So that means now that there will be a total debit here of 20 Rand. Just explain that to you. Remember now, the partnership is paying this guy, paying Johns 260 Rand. Ross is going to pay in 240 Rand because he's got a debit balance. So the business is paying out 260, getting in 240. Therefore, the net effect of that would be a minus 20. Right? We are paying out 260. We are receiving in 240. So the net effect is a minus 20. Now, in this example, what I've explained to you now, the transfer to the asset replacement reserve, salaries to partners, interest on capital, interest on current account, and interest on drawings, those were the conditions of the partnership agreement for this question. The next line deals now with the share that must now be transferred to the partners' current accounts. You label it as the partner's share of the profit. You first calculate how much is available. So you take the 100,000 minus the 10,000 minus the 60,000 minus 1,000 minus 20 plus 25 plus 250, and you first calculate the available profit. So the available profit will be 100 minus 10, which is 90, minus 60, which is 30, minus 1, which is 29, minus 20, which is an amount of plus the 250, I get 29,230. 29,230 on my example. First, calculate the available profit. And once you've got the available profit, now you go back to the partnership agreement to share that profit. If the question tells you that the profit must be shared equally amongst the partners, then you transfer to each partner's current account 14,615 is now transferred to each one's current account, 14,615. Important to note that when we speak about the partner's share of the profit, you must first calculate the available profit. Many students take the 100,000 and divide that. It is wrong to do that because the 100,000 Rand is the profit that was calculated in the statement of profit and loss and other comprehensive income. But thereafter, you must take into account the conditions of the partnership agreement. There may be 10,000 Rand that must go to the asset replacement reserve, 60,000 Rand to salaries, 1,000 Rand to interest on capital, 20 Rand to interest on current account. 50 Rand will come in from the interest on the drawings. Use all of that figures there and first calculate how much profit is available. Now we have seen that 29,230 is available, and then you divide that amount. Okay. Lastly, you bring into account the drawings for the year. Remember, the drawings is closed off to the current accounts, will decrease the current accounts, and your final answer, just add that all up in the columns, add up in the columns, and that will give you the balances at the end of the year is then all contained in your statement of changes in equity. Right, guys, I'm going to entertain questions for you guys now on the statement of changes in equity. Carmen, did I answer your question? Okay, Carmen is all good. Bianca's got a question.
No, I'm all good, thank you.
All good. Okay. Right, guys, let us continue. The next financial statement that we are going to focus on is the statement of financial position. And the statement of financial position, once again, the same as in the case of a sole trader. You get your assets, non-current assets, your current assets, giving you your total assets. The only difference comes in with your equity, of course. Equity will consist of the capital accounts, add A plus B's capital accounts, the current accounts, and the asset replacement reserve. Block that, you add it up, and that will give you your total equity. Everything else is the same. Okay, you can take a look at the explanations that I've got there at the bottom for you, and that should be enough information to refresh your memory then on the statement of financial position. So let us continue, and we take a look at a question for you guys. The question that we're going to focus on today is coming from the October-November 2018 question paper for the FAC1602. And in the question, we are dealing with a partnership called Busi and Lesejo. They are trading as Alex Traders, and they are in the business selling vuvuzelas and other soccer souvenir products, and the following information appeared in the books. The balances on the 30th of September 2018. See there, capital accounts, both partners. Current accounts, both partners. There's trade payables, there's bank, there's property, plant and equipment, there's inventory, which is the opening balance, there's trade receivables, there's loan to Busi, there's loan from ABC Bank, and then they give you the profit for the year. So in your list of accounts, if they give you the profit for the year, it will mean that the statement of profit and loss and other comprehensive income has been completed already. Now we take a look at the additional information. Under the additional information, they tell you now the partners, Busi and Lesejo, they share profits and losses in the ratio of 2:1. Both partners are entitled to a salary of 6,000 Rand per month. Be careful for that one, per month. And then they tell you that the interest on capital is charged at 6% on the closing capital balances. And then under number 2, there's year-end adjustments. Busi and Lesejo drew 8,000 and 6,000 from the entity for their own use. So that would be drawings. And then they also tell you each partner received 40,000 Rand as a salary for services rendered to the partnership during the year. Remember now, salaries were paid out during the year. They received that money. So if they have received the money, we've paid out the salaries, we don't call it salaries, it is recorded as drawings. The question asks you now, under your required, prepare the statement of changes in equity. Prepare the statement of changes in equity. And guys, I am going to go work with you then now on this statement over here. Statement of changes in equity. Let me just get my sheet up here, and we are going to take a look at this question there. Right. So when you prepare the statement of changes in equity, you're going to have the capital account for both partners, a column for each partner, the current account for both partners. In this question, there's no asset replacement reserve, so you will exclude that column, and you will have a column then for appropriation. So we start off with the balances as at the 1st of October 2017, the opening balances. The capital account of Busi at a balance of 90,000. The capital account of Lesego, opening balance there of 70,000 Rand. The current account of Busi has got an opening balance of 15,000. And the capital account of Lesego had an opening balance of 10,000 Rand. In the question, if you focus for me on the question, you will see that they do not indicate the balances, or they actually, no, they do actually indicate it. Both of those accounts have got credit balances, and credits is positive. Remember, a debit balance is a negative balance, and a negative balance is indicated in brackets. So those are the opening balances. We've got no information on any increases or decreases to the capital. Remember, that comes after the balances. But there's no information given to us on increases or decreases to the capital. So on my next line, the total comprehensive income for the year, the profit for the year, we have transferred from the statement of profit and loss and other comprehensive income, the profit for the year, 182,300, and that has been transferred to my appropriation account, my appropriation column, because in that column, I must bring into account the conditions of the partnership agreement. Right. The conditions of the partnership agreement stipulate that partners are entitled to interest on their capital, and the interest on the capital is 6%. 6% on the capital, which means that the current account of Busi, we will transfer his share of the interest, and that is 5,400 Rand, which is 6% of the 90,000. And we transfer to the capital account, or I'm sorry, to the current account of Lesego, his share of 4,200 Rand is transferred in there. The available profit will now decrease by 9,600 Rand. Any questions on that calculation? Quite straightforward. The partnership agreement stipulates that the interest on the capital accounts of the partners must be calculated at 6% on the opening balances of the capital accounts. So you will take the 6% of that and you will calculate that amount, and the amount of interest that they are entitled to, we transfer that to each partner's current account, and it will decrease the available profit. The next condition of the partnership agreement states that partners are entitled to salaries, but they are entitled to salaries of 6,000 Rand per month. That will equate to 72,000 Rand for the year. You take into account the annual salaries. So we transfer 72,000 to each partner's current account, and the available profit will decrease by 144,000 Rand. Available profit, 144,000. Those were the only two items that will impact on our profits as per the partnership agreement. So the partnership agreement stipulate now interest on capital and salaries. Your next step is now to calculate the available profit. So after we have made provision for the interest on capital and the salaries, the available profit that is now available to be divided amongst the partners, calculate that amount first, and that is now 27,800. 27,800 is now available to be shared amongst the partners. It is 182,300 minus 9,600 minus 144,000, and that is 27,800 there. First, calculate the available profit. And now you go back to the partnership agreement to see how that's...
Sorry, sir.
Sorry, sir.
Yeah.
That's
okay.
28,700.
It is?
28,700, not 27,800.
Okay. No, I think I'm a bit dyslexic there.
Sure.
Okay. You say it's 28,700, 182,300. Let me just check what my calculator is saying. $28,700. Absolutely fine. Okay, I can live with that. Right. So now we have calculated the available profit. The profits will now be shared amongst the partners in the ratio, and you will see there that it is indicated there that the ratio given to you just quickly make that a little bit bigger for you guys. The ratio given to us is in the ratio of 2:1, which means now that if we want to calculate what is the share of the profit that Busi is going to get, we say it would be 28,700 times 2/3, because Busi is entitled now 28,700 times 2 divided by 3. Busi is entitled to an amount of 19,133. Rounded off there, don't still show the cents there. 19,133, that is the share that Busi is going to get. And the other partner, who is partner Lesego now, partner Lesego is going to get now, after 28,700, as per partnership agreement, Lesego is going to get 1/3 of that. And that will equate now to the 28,700 divided by 3. And that is an amount of 9,567. Right. So we transfer now to the current account of Busi his share of the profit, which is 19,133. We transfer to the current account of Lesego his share of the profit, 9,567. We transfer to his current account. All clear on that?
Sorry, just a question. Just a question. On the partner share of total, why is the 28,700 in a minus?
Okay. Right, let me just quickly explain that to you. Right. You will recall that we made a profit of 182,300. That profit will decrease because we transferred to the current account because of interest on capital. We transferred 9,600 and the available profit decreased. The available profit decreased further due to salaries. The available profit will decrease further because we transfer a profit to the current accounts. So at the end, your appropriation account must show a zero balance because all the profits has been allocated. 9,600 has been transferred for interest on capital. 144,000 has been transferred for salary, and 28,700 has been transferred as the share of the profit. If you are not happy with that, debits must be equal to the credits. So just have a look here. Yeah, just have a look here. There is a credit of 5,400, a credit of 4,200, which will equate to a debit of 9,600. A credit of 72, another credit of 72 is a debit of 144. A credit of 19,133, a credit of 9,567, it equates to a debit of 28,700. That is why that amount must be in brackets.
Now
Okay.
I understand. Thank you very much. Now it makes sense.
All right. All clear? Right, guys. Now we're on to our drawings now. Drawings will decrease the current accounts now. And the current account now, the drawings of partner Busi will now be the amount of 48,000 Rand. Remember, as far as the drawings is concerned, he withdrew 8,000 during the course of the year from the business. And then the business paid him a salary of 40,000 Rand during the year, and he's taken that 40,000 as well. So in total, his drawings is 48,000 Rand. On the other hand, Lesego, his drawings will be an amount of 46,000 Rand. He took 6,000 and we paid him 40,000 Rand as a salary. Important to note that whenever a salary is paid out during the course of the year, it is recorded as drawings. Right, that will bring us to the end of this question. We will now just calculate our final balances here. The capital account of Busi has got a balance of 90,000. Somebody say, please. Can't you see the screen?
No.
Okay. Let me just quickly sort out that for you. I'm gonna get that. I think you'll be able to see it now. All good? Just give me a thumbs up from somebody, somewhere.
Yes, sir.
Okay, you can see it. Thank you very much. Right, so I think you perhaps didn't see the drawings there. All clear on the drawings? The 48,000 and the 46,000. So now we go to the balances at the end of the year. We just add up. Busi is 90. Lesego is the amount of 70,000 Rand there. The current account balances then, just add up there the 15,000 plus the 5,400 plus the 72,000 plus the 19,133 minus the 48,000 will give you a balance of 63,533. And we add up the current account of Lesego, 10,000 plus the 4,200 plus the 72,000 plus the 9,567 of his share of the profit minus the 46,000 will give you an amount of 49,767. And that will conclude our statement of changes in equity. Right. So just to summarize, guys, what we have done today, is that we did the introduction then to partnerships. We discussed the statement, all the financial statements. Remember now the financial statements of a partnership is now the statement of profit and loss and other comprehensive income, statement of changes in equity, statement of financial position. Statement of financial position and statement of profit and loss and other comprehensive income is the same as what you have done under 1502. The real difference comes in with your statement of changes in equity. And remember now in your statement of changes in equity, we've done an exercise, but it can become quite complicated also, guys. It's not always as easy as what we have seen now. We have worked through one paper or one question, which was from the 2018 exam. I have also put in your notes. I will attend to that question now. In your notes, you will see that there's also a second question on the statement of changes in equity. And I want you to attempt that one then as a homework activity, so that we can discuss it next week again. So next week, please take some time, guys, to actually work through that question and see if you can handle that question. Mr. Pillay has asked a question. Can you please repeat how you calculated the drawings amount on the screen? Oh, no, I don't need to worry. Ms. Jones has answered him now. The drawings consist of 8,000 Rand that was taken during the course of the year, as well as 40,000 Rand of salaries. And so remember now, if salary is taken during the course of the year, then we record that as drawings there. Okay, I don't need to say anything anymore. Ms. Jones here is saying, please refer to your notes. Everything is in your notes there. That is what Ms. Jones is saying. I don't need to say anything anymore. Guys, we are closing off today's section. I will post your notes now, say by Wednesday. I will post the notes then for the next class. Please complete the feedback form as well, and also complete the register so that we know who attended this. Okay. I will entertain any questions now, guys, in the next few minutes. Any questions? May I ask that you upload the answers so that we can refer back? Do you really want the answers? Normally, like what you are doing is always correct, so that will be the answers. Okay, guys,
No.
in your notes, in your notes, I will then also upload the answers there. Okay. Any other questions? Bianca's got a question. Right, guys, enjoy the rest of the afternoon and keep well and keep safe. Thank you.
Excuse me, sir.
Okay, yeah, is somebody coming? Yeah, I'm listening.
It's not specifically a question related to what you've covered. Everything you've covered is quite clear, but you did mention that in certain cases the question would be a lot more complicated, and I did do FAC 1501 with you, and everything you went through with us was fairly easy to understand, but then the questions in the assignment and then the exam as well were a lot more complicated. So I'm not sure if other people also experienced that, but possibly if we do one of the other question papers in the future moving forward, if you can choose one of the more tricky questions at some point, so that we definitely have one that's fairly straightforward, but also one that's tricky, that throws a few curveballs at us.
Okay, so now if you attempt the homework activity, that will be a few curveballs. Okay.
Okay.
All right. Okay.
Yes, sir. Thank you.
Okay. Somebody, Elvira, is just asking for the feedback link. The feedback link, just go onto your Teams again, and then there is an icon called next to the files. There is an icon called quick links. If you click onto quick links, then you will be able to get that there as well. The feedback link is there.
So would you just repeat